Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for February 20th, 2013. Well, this week I want to talk about price channels. They are one of the most reliable technical analysis concepts, but often overlooked. To define a channel, we simply draw lines across the tops and bottoms on a trending chart, and in doing so, we want to try to make those lines parallel. Price will oscillate between the upper and lower boundaries of the channel, and the tendency then is to want to sell stocks when they're at the top of the channel and buy them when they are at the bottom of the channel. If we look at a chart of price line, which has been in an upward trend for 4 or 5 months, we can see that every time it got to that lower boundary, it bounced, and when it got to the upper end of the channel, it became too risky to buy. I expressed my bearishness on the stock back in August when the stock gapped up to the top of the channel because simply it was at the top of the channel where it was likely to find some resistance. Well, it did pull back and has since bounced off the channel, and now it's looking like it's going to trend upward toward the top of the channel again. So as analysts, when we're looking at charts, we want to keep an eye on where those channel lines are. We want to draw lines across the bottom and then try to draw a parallel line across the tops. And in doing so, you can get a sense of where strong stocks are overbought and where they might also be oversold and worth buying. And if we flip that upside down, stocks in a downward trend, you can identify when they're oversold and likely to bounce, or when they are likely to continue lower simply by drawing those channel lines. Very simple concept, but keep it in your toolbox for analyzing the market. Now, if we take that concept and apply it to the S&P 500 this week, you can see that we rallied up to resistance. We talked about that last week, likelihood of the market rallying up to resistance at the top of the channel where it got stuck on Thursday, and now, perhaps not surprisingly, it is moving lower and probably destined toward the bottom envelope of the channel. Now, does that mean that the bullish trend is over? No. Simply in the short term, it's a little bit overbought. We've had a good rally through the month of September, and it's likely that the market will now pull back toward the bottom of the channel. Let's take a look at the TSX, which is really not a trending stock, so we can't apply the same sort of channel analysis to it. This is a market that has been stuck under resistance for some time, and we're right at resistance now, and hopefully we'll see a breakout. Now, I've drawn also the head and shoulders bottoming pattern. You can see the left shoulder, the head, the right shoulder on this pattern. We are now at the neckline where the market could make that breakout through resistance. We need that breakout to happen before we can get bullish. So for now, we can only be on the optimistic side of neutral. And the reason we can be optimistic is because the bottoms are rising from left to right. What we now need is that catalyst that will break the market through resistance and into an upward trend so it can start to play catch up with the US market. All right, moving along to the US Treasuries. We got a little bit of a lift on Wednesday when the Fed announced that they would not pull back some of its monthly bond buying stimulus. That gave it a little bit of a jump on Wednesday, but it didn't break the downward trend line yet. We've started to slow the momentum of that downward trend line, but ultimately we need a break through the 106 price mark on the TLT. That would imply that the buyers are coming back into Treasuries. I think that is likely to happen in the near term because the downward momentum is slowing, and it seems like the US Federal Reserve isn't going to stop printing money anytime soon, and that'll positive for US Treasuries. The China market, FXI is the ETF. It broke out through resistance earlier this week. That's a positive. The only problem here is that it is at the top of its channel. In other words, it's a little bit overbought. So we have a bullish market in the near term anyway, a bullish market, but one that is likely to pull back before it goes higher. So I like this looking out perhaps a month. I think in a month we'll see this market higher, but in the next week or two, probably lower simply because the buyers have gotten a little bit too enthusiastic in the short term. Emerging markets, a very similar situation where a great month of September as the emerging markets bounced back from being really oversold, but that did not break the downward trend line. So we've had this big rally. It's come up to the downward trend line, which I've drawn in red. And in the short term, it's likely to pull back before it makes an attempt at breaking that downward trend line. Now, the Canadian market, which we talked about just a moment ago, is likely to break out through resistance if the emerging markets can break out through this downward trend line. So I think it's pretty possible that it's going to happen in the next month or so. But in the short term, because we've had such a significant rally in the emerging markets in the last few weeks, I think that we're probably going to pull back before we break through that trend line. US dollar really got hammered on Wednesday because of, again, the Fed's announcement that they weren't going to taper, which the market really expected that they would. And that has taken the US market, or pardon me, the US dollar market, down to long-term support. Look at how many times the US dollar has bounced off of support, which I've drawn in red there. That happened in September of 2012, in October, in December, in February, and now we're approaching it again. So the US dollar weakness in the short term probably doesn't have a lot of downside. That, in the short term anyways, is not great for commodities. I think commodities got their lift from the break downward in the US dollar on Wednesday. But in the near term, I think the US dollar is going to hold this level and probably bounce off of it. Gold is an interesting chart. We've got a downward trend in the long term. We rallied up to that, and we've talked about that a number of times in my weekly videos. We've hit that resistance line at the downward trend line, couldn't break it. Gold had a nice pop on Wednesday when the US Fed didn't taper. We've talked about that enough now. But it hasn't broken that downward trend line. So in the short term, we've got an upward trend line, which I've drawn in green, that was broken about a week and a half ago, and we're now testing that again. So this chart tells me that I'm going to say 60% chance the downward trend continues, a 40% chance that the market for gold is able to break that long-term downward trend line. That's pretty close to even odds, and so it makes it a difficult market to call. I think you really don't do anything in the gold market unless you see a break below that 125 mark on the GLD, which would be a bearish sign because that would mean that we've switched back to falling tops, or a break of the long-term downward trend line at 135. That would be positive, and at that point you can start to be bullish on the gold stocks, the gold mining stocks, and gold in general. So for now I remain bearish, but we're really at a pretty critical point where things can change very quickly. All right, here's the chart of oil. And we've got that upward bias with rising bottoms, which I've drawn in green since August. The Syria situation allowed for a breakout, but as I've said in recent weeks, I think some of that breakout was simply due to the fact that emerging markets were getting better, particularly Asia was getting better, Brazil not so much, Russia okay. So we've got a market where you're competing with the pessimism that comes from Syria maybe getting their stuff together and releasing information on where their chemical weapons are and blah, blah, blah. That helps oil prices from the Middle East side. But then you've got global expansion, which is helping oil prices go higher because obviously if the global economy is getting better, then oil prices should improve as well. So you've got these two competing forces right now. You can see those competing forces coming together by the diminishing volatility. I've drawn the green line sloping upward and that angled red line sloping downward. They're coming together. That means we're getting to a catalyst point where the market's either going to break up or break down. So for now, I'm going to say I'm neutral with a slight optimistic bent because we do have rising bottoms in this chart. But ultimately, we want to see what direction the market breaks out of the sort of the sharp, pointy end of the triangle that I've drawn in this chart. If we get a breakout to the upside, likely going higher. If we get a breakout to the downside, likely going lower. All right, the VIX, the VXX is the ETF, breaking through support. That tells me that headline risk, fear, all those things that we've been dealing with for the last 5 years, 6 years, since 2007, really continue to not be a factor in the market. We get these brief little blips up in the VIX when there's something going on in Syria or something going on in Libya, But in the big picture, the whole financial crisis, meltdown of the financial world, that's not a factor anymore. It was a factor in 2008, but it's really not a factor anymore. And so I think we can start to take our eyes off of the VIX, at least for now, as it's going lower. So my outlook then, neutral on US stocks and Canadian stocks. US stocks, bullish long-term trend. Top of the channel means it's going to pull back in the near term. That's why I'm neutral. Neutral on Canadian stocks, building an optimistic pattern, but needs that breakout through resistance. That's why I'm neutral, but a little bit more of an optimism towards the future. Gold bearish, hasn't broken that downward trend yet, but that could happen anytime. Oil neutral, but again, the bias is optimism. We just need the breakout from the tip of that pennant pattern that is building. US stocks have rallied up to resistance where it is likely that they will stall and see some profit taking in the short term. Canadian stocks are still working on breaking out through resistance while oil tests its optimism and gold is trying to fight its pessimism. That has been the Stockscores Market Minutes for September 20th, 2013. Have a great week in the market and trade well.